458-9326. Answering your questions here with the Certified Financial Group. And Pat called that number to get his question answered. Pat, you want to go ahead and explain to the guys what you got going on this morning?
Good morning, Pat.
Yeah, I've been talking with my wife. We have a rental property over there in Apopka, and we're thinking about selling it, paying off this property with me coming up to retirement. And, of course, you got capital gains, but my brother's in real estate, and there is a thing where if I move back in, set that up as my primary residence, live there for a year, is that logical or no?
You know, it's probably not, Pat. First of all, you'd need to live there a couple of years, but how long have you had this rental property?
I've had this rental property since 2007.
Okay. What's the gain? How much are we talking about in gain?
We're talking about
$200,000 of gain?
Yeah.
Yeah, and Pat, sometimes when people think 200, they're thinking, well, just as an example, I paid 200 and it's worth 400. So just for you and for our listeners, sometimes the gain is a lot more because of something we call depreciation recapture. So you know that all these years you've been depreciating that property and getting a nice deduction for it. And assuming that deduction was in fact deductible, for folks married filing joint, when your income's above $125,000, some of what we call passive losses, I know we're getting into the weeds here, but some of those are no longer deductible. They're suspended and carried forward. But let's just assume you were able to take those losses, Pat, and now you sell the property. In addition to calculating the gain, which is simply the difference between what you net on the sale and what you paid for it, less any improvements, but then on top you have to recapture the depreciation, and that adds to that total tax gain. So there is a law, and this was after the financial recession, where you're not able to get out from underneath that depreciation recapture. You're going to, even if you convert this now into a residence and you live there for a couple of years, you're still going to end up proportionally having to recognize that gain. So based on the number of years it was rented versus the number of years it became your residence. So it's you can't escape the gain. You can minimize it a little bit, but because it's been rented so long, you're going to be paying the gain.
But the gain may not be as bad as you think it is, because the way
be.
the gain kicks in, 0, 15, and then 20 once you're over.
Yeah, so a lot of people don't know, but for income, roughly around $105,000 total. For married filing joint, you subtract a $25,000 standard deduction, and you get right at that 12% bracket. If your income is below that, including the gain, the long-term capital gains tax rate is actually 0. Now, that's what the law is today. Obviously, they're going to tinker with the law here in the future, but we oftentimes will meet with clients, and they will have had maybe $60,000, $70,000 of income in retirement, and we say, darn it, you could have sold an asset with a $40,000 long-term capital gain and paid 0 taxes on that, and actually reset your cost basis higher so that you don't pay taxes in a future year when your income is higher. But Pat, we'd be happy to talk you through the calculation if you want to give us a holler on Monday. We've got 2 CPAs here in the office. Rodney Owenby and myself would be happy to take your call and go through the calculations with you so you know where you stand.
Actually, we have 3 CPAs. Kathy.
Oh, I forgot about Kathy. Oh my goodness.
She's not a planner, but she works.
Right, we do.
She works in our office in administration, but she's a CPA as well. But we'd be glad to help you, Pat. The questions that you're asking are great questions, but then you wonder if it's really worth the hassle of going through that. And then you might be up against it. Well, you're married though, so you get under current law $500,000 exclusion on the gain on the personal residence. But as Gary said, it's got to be 2 years, 2 out of 5 years to be able to claim that exemption.
And then again, the law changed after the financial recession, where it's a proportional. You're not going to be able to get all of that gain excluded. because it was a rental property.
Right.
It's a little known change in law. So,
Yes.
and it is complicated, Pat. But by all means, if you've got a tax repair, run it by them. If you don't, run it by us, and we can tell you how that works.